Hi everyone, this is Joe Gentili with Saraf Gentili LLP. In this video on life insurance and the law, we're going to talk about index universal life insurance or IULs and what makes them particularly risky, in my opinion. And probably the funniest, like as for what it is, the funniest tongue-in-cheek explanation I've heard of it. I can't remember who said it, so I can't properly credit it. Um, but it was described as a term life insurance policy with a slot machine attached to the side. And that's not, I mean, obviously it's not 100% accurate, but it's pretty close. There's some truth to that. These are frequently marketed as being very conservative, safe ways to save money and to potentially fund your retirement, but they're actually quite risky for a number of reasons. And so what the policies are they are permanent life insurance policies that can stay in place for life. And like other forms of permanent life insurance, there's cash value that accumulates with the policy that is supposed to fund the death benefit for later on. So the idea is that you pay your premium, and part of that premium goes to paying the cost of insurance to insure you for that year, and then part of the premium is set aside and invested or credited based on the performance of some index. And over time, that cash value is going to grow. And over time, that cash value is going to subsidize and ultimately pay for the continuing cost of insurance for the policy and hopefully keeping it in force for life. That's a very simplified version of how these are supposed to work. Now, where the problems come is that, unlike some other forms of permanent insurance, like whole life, where the cost of insurance is the same every year. So if I get a life insurance policy at 40, um, it starts out looking very expensive. Let's say the premium is $10,000 to get a $500,000 death benefit. When I'm 40 years old, that's very expensive, right? But it's the same price for life. So it's the same price at 40, or the premium's the same for me at 40 as it will be at 90. So at 90, paying that much for that size death benefit is very inexpensive. The cost of insurance is not guaranteed with most universal life policies and most IUL policies. And so every year that cost of insurance goes up to reflect higher cost to insure an older person. And in an ideal world, if these indexes that they're giving you are performing really well, they are more than keeping pace with the cost of insurance. They're performing ahead of it, and you don't have to worry about the cost of insurance increases because you have the cash value to offset it. But if it doesn't work out that way, then the policy could lapse because over time the cash value is going to decrease. And if there's no cash value left, it lapses unless the person who has the insurance continues to pay this ever increasing amount of insurance. And this is a negative surprise when this happens for a lot of people because in almost every other area of life, the cost of insurance and premium are the same thing. That's not the case with life insurance. Cost of insurance and premium are not the same. So you could pay your premium every year and the policy could still lapse because the cost of insurance is going up. So we see problems for people with that's particular to index universal life in a couple of areas. One is related to they're kind of related. One is related to the complexity of the policies, and the other is the sales practices. So as far as the complexity goes, what I had just described about the cost of insurance increasing every year, and the premium being invested in indexes and is supposed to keep up with this increasing cost of insurance. Most people don't understand that when they're buying these policies. Most agents don't adequately explain it. There's a lot of levers in these policies as well that are not guaranteed. So the cost of insurance amount is not guaranteed. After you buy the policy, the insurer frequently reserves the right, based off a number of factors to raise the cost of insurance later. So the costs that are laid out when you buy the policy may increase substantially later on. So the insurer retains a lot of discretion to change the cost of insurance. You may also be shown indexes with participation rates and caps. Like let's just assume the simplest version that it's hinged to the S&P 500. You may be able to participate in 100% of the S&P 500's gains for the year, subject to a cap of, let's say, 10%. So if the index performs at 30%, it's a great year, you're limited at 10. Now, the insurer retains the right to change the caps, so they could drop it from 10 to something below that if they want to. They can change the participation rate. They could drop it below 100%. They can change the indexes that are being offered to hinge your crediting to. So nothing is really guaranteed in the policy, and it's a very long-term hold. So you're trusting the insurer is going to kind of keep things in place for what hopefully will turn out to be many decades. There's a lot of risk in that that's sometimes not clearly communicated and not completely understood. The indexes themselves, most people are kind of steered away from the S&P 500 these days and put into what are known as engineered indexes. Those engineered indexes carry a lot of risk in their complexity. So they have all sorts of hidden charges, I would say, in them that aren't always completely explained. Like the vast majority of engineered indexes offered today are volatility controlled excess return indexes. And what a lot of people don't know is that in order to offer these fantastic participation rates and caps that are in these policies, there's a lot of levers that the insurance company bakes into the index to kind of put a lot of downward pressure on how high those indexes can go. One of the most prominent ones is frequently interest rates are deducted from your return. So let's say interest rates are currently at 5%. Before that index can credit you any money, it's got to earn more than that. So if the index earns 4%, let's say, and there's a 5% interest rate that's deducted, well, you've earned zero. If it earns 6% and you got a 5% deduction, then you earn 1%. So it functions like a very large fee on these, which keeps the returns down. So there's a lot of risk in the hidden costs. Then when we get to the sales stuff, again, these are really, really complex financial insurance. In my opinion, the vast majority of agents that sell these don't understand all the moving parts, let alone are they communicated in a way that's clear. And in my opinion, a lot of the carriers facilitate that. So it's very difficult to understand what it is that you're buying when an index universal life insurance, unless you spend a lot of time like I have digging into these and trying to get your arms around how they work. And along those lines, it's very, very crucial to understand that the illustrations that are being put in front of you, they are not meant to be projections. They are frequently, unfortunately, used as projections. They paint very rosy pictures as to how these policies will perform over a long period of time, but they're not predictive at all. And what a lot of people don't understand is because these policies are in place for such a long period of time, even missing projections by a minor amount, what seems like a minor amount, because these results are compounded, can result in very large differences over time. So if you're shown a projection and the assumption is that the policy is going to earn or get credited 6% a year, and it shows that if you fund it at a certain rate, that's going to keep it in force, until age 90. Well, if you miss that 6% and you're averaging 5%, or even if you hit the 6%, but your sequence of returns, in other words, one year you get 10, another year you get zero, it averages out. Depending on that sequence, you could come in way under. Even a small miss or relatively a small miss compounded over decades could mean that a policy projected to stay in force to 90, maybe it only stays in force until 70. This is compounded by another issue. The incentives, the sales incentives would index universal life. Everything that I'm describing, all of this complexity, these policies can work out if they are monitored closely by a professional and if they are funded in a way to get ahead or way ahead of problems as they're showing up. So in reality, for these policies to work out for most people, it requires a professional to look over them every year, every other year with some regularity, just to see if it's still on course from where it was um, initially projected to be, and what changes need to be made to keep the policy healthy. And unfortunately, that doesn't happen a lot because of the commission structures. So think about it. If you're an agent and I sold you a policy and I earn a commission, most of my commission is going to be earned in the first year I sell you the policy. This policy is going to stay in force hopefully for another 30, 40 years. What incentive does the typical agent have to check back in with this client every year for decades? How many of them are going to be in business for decades or alive for decades to make sure that this is being funded correctly? So it is not a set it and forget it product where as long as you pay the premium, the policy stays in force. That may be true with term life insurance. That may be true with whole life insurance, although even I think those products require some monitoring. That is especially true for index universal life. It really needs to be monitored closely, and adjustments need to happen over time. You can't just set a course when you buy it and just stay on that course without checking in on it. So all of these issues that I'm describing, in my opinion, they make this product a lot more risky than it's frequently positioned for people. If you bought one of these policies and you're starting to realize you didn't fully understand what it is that you bought, or you feel like you were misled in some way, it's probably a good idea to consult with an attorney because you may have a claim. These policies, because they're so long term, um, it's a lot of money if you made a mistake with one of these and you continue to fund it, and you put yourself in a position where you could have a lapse a couple of decades down the line. Because lapses, it's not just the worst case scenario that you lost all the money that you put into the policy. Oh, that's awful enough. That could happen. If you have loans outstanding when the policy lapses, those loans can be treated as income, and you may be taxed at ordinary income for those loans if there's a lapse later on with loans in place. Your health condition may also change. So you may be insurable today, but if you see this problem and it lapses later on, you may not be able to replace the insurance. So if you bought this and you really didn't understand what it is you bought, or you felt like you were misled, it's probably worth it again to consult with an attorney and see if you have a claim to try to fix the situation. If you have any questions, you feel free to reach out to me. I'm happy to review policies and review situations to see if there's anything that we can do to help on the legal front. So with that, I hope you found this video useful. We're going to make a lot more on the topic. So if it is, please subscribe. Thanks for watching. Bye.